We have some of the smartest people in the entire world working in the financial services industry, PhDs from top universities in theoretical physics, applied math, computer science, and some of the most sophisticated technology possible, but still, quant models break. Why is this the case? Look at 2008, for example. How many quants were in charge of measuring and managing risk for all of these institutions that ended up going bankrupt or getting bought out? It is wild to see during these black swan events that there are no adults in the room. And that's because nobody knows anything that you don't. Even with all of the sophisticated models and technology, they aren't able to predict the future. And that's exactly what we're going to talk about in this video. Whether a system is random or uncertain, nobody can predict the outcome of any one event. The only event that you can predict with certainty is access to my Jupyter Notebooks. This Jupyter Notebook will be linked in the description below. I will also post it to the Quant Guild library on GitHub, where you can find all of my Jupyter Notebooks and associated YouTube videos. At the top of this Jupyter Notebook, you'll notice some related Quant Guild videos applying probability and statistics to finance and trading. This idea of time series analysis, retail versus institutional trading, trading versus investing, this idea of accumulating positive expected value in some sort of random or uncertain system, the difference between quant and discretionary trading, and busting 3 trading myths with math. If you're unfamiliar with any of these ideas, I highly recommend you check these videos out first before approaching one like this. Moreover, these videos certainly take a lot of effort to create, so if you'd like to help support the channel so I can continue to create videos just like this one, please like, comment, subscribe, share. It helps me out tremendously. It is always greatly appreciated. And if you'd like to master your quantitative skills, check out quantguild.com. Maybe you come from a background in business, economics, computer science, and aren't too sure where to get started on your quant journey. Maybe you're an aspiring quant or a working professional looking to sharpen your quantitative skills. In any case, Quant Guild is for you. We have over 90 quant lessons in math, probability, finance, an adaptive practice engine that scales with your skill level so you can progress to more and more difficult topics with gamified, rank-based progress, interview questions with fully worked solutions, trading games, courses where I teach you everything that I know about math, coding, probability statistics, data science from my experience as a quant and my education at an Ivy League university. Our first course is being released at the end of October with over 20 hours of content. And all that is included with Quant Guild membership. And you can get started right now for free. So if you'd like to help support the channel and master your quantitative skills, check out quantguild.com. And if you'd like to meet with me one-on-one, I will leave a link to my calendar in the description below. I've been having some great conversations with students and professionals alike, helping students figure out where to focus their study efforts, what universities and graduate schools to apply to, and helping professionals build out their trading and research pipelines. Again, if you're interested in chatting one-on-one, I will leave a link to my calendar in the description below. Without further ado, let's first understand the difference between a random event, a random variable, and an uncertain event. This is pivotal to understanding why exactly it is these quant models break. First, we have to understand that the stock market is not random, it is uncertain. There's a very big difference between the two. This is a major point of confusion for both students and folks new to the finance and trading space. I have 2 really good examples of each system. We're going to take a look at a weighted coin flip and a sports betting example. We're actually going to use the Giants-Broncos game that went on the other day, an absolutely egregious performance for my boys in blue, but I will digress for now. In any case, we have to understand the difference between these 2 systems to understand exactly why it is these quant models break down. So let's go ahead and get started with this idea of a random system, a random event, or a random variable. Whenever the set of possible outcomes are fixed, along with the associated probabilities of those events, you can think of something like a coin flip, the number of coin flips out of 10 that were heads, even the distribution of average coin flips, we're dealing with a random system. These are random variables fully specified by their probability mass or density functions, cumulative distribution functions, characteristic functions. We're not going to focus on the probability theory. Instead, we're going to actually take a look at these distributions here. This is literally the distribution of a weighted coin flip. This is literally the distribution of the number of heads out of 10 flips of that weighted coin. And this is the distribution of sample averages. All of these are random variables. We have X, Y, and Z. They are defined in terms of these distributions above. Our goal is never to predict the outcome of any one of these random variables. That is impossible. That is not the purpose of this mathematics. The purpose is to make informed decisions in the face of uncertainty. So if I told you you had to bet on this weighted coin flip, what are you going to bet on? Are you going to bet on heads or are you going to bet on tails if they have the same payout? Well, I'm going to bet on heads because that has a 70% chance of occurring and tails has a 30% chance. So this is literally giving us information about the likelihood of different states of the world. Look at the binomial distribution. If I flip a weighted coin 10 times, what are you going to bet on? Are you going to bet on there being 10 heads? No, you're going to bet on there being 7 because that has the highest likelihood of occurring. This is the purpose of these random variables. You have to make a decision in the face of uncertainty, and you're using this as a model to inform your decision making. Now, fortunately for us, if we're dealing with a random system, then everything converges. That means that these probabilities literally represent the states of the world that we could operate in. They converge if we were to simulate the exact same event a large number of times. I have a great example of this using that weighted coin example. Thanks to the law of large numbers, we know that probabilities and statistics in random systems converge. In other words, if I take this distribution of 10 coin flips and I'm trying to measure the number of heads that I get from flips of that weighted coin, how many should I see on average? Well, very trivially, I can just take those 10 coin flips, multiply by that 70% weight, and I will get 7 heads. So on average, I'm going to see 7 heads. But how do I know that this is fixed? How do I know if I keep flipping that weighted coin, I am in fact going to see 7 heads on average? That is going to be the highest likelihood event of occurring. Well, if we take a look at this simulation, what I'm effectively doing is I'm flipping a weighted coin 10 times and I'm recording the result. Did I see 3 heads? Did I see 7? Did I see 10? And then I'm plotting it on a bar chart. And I'm just going to do that a very large number of times, 1,000, 5,000, 10,000 times. And what you're going to see here is this distribution representing the total number of heads out of 10 coin flips is going to perfectly converge to the theoretical distribution that we discussed above. This is not by accident. This is by the law of large numbers. This is why when we're operating in a random system with predefined probabilities, it's very easy to make decisions. If you told me that you were about to play roulette, I could run for you the numbers and show you that you have a negative edge. If you continue to play and you can't martingale roulette, you will statistically, with certainty, lose all of your money. That is effectively what it means to operate in a random system. The probabilities and the sample space does not change over time. If I'm playing roulette, I have green, red, and black. I'm not just going to see blue all of the sudden. That is what it means to operate in a random system. This is fundamentally different from an uncertain system. Let's take a look at a sports betting example now to really understand the difference and what exactly is going on. Unlike with the random system we just saw an example of where probabilities converge, anytime we're dealing with an uncertain system, whether it's sports betting or election betting, trading, investing, and we have some sort of probability, it's not actually a probability. It's an implied probability. There's a very big difference, and this is fundamentally the difference between a random and an uncertain system. There is no convergence, and a good example of this is the Giants game the other day against the Broncos. When they went marching on into the fourth quarter, they had a 99.8% chance to win. Then that fell to a 3.3% chance. I have a simulation of this here. You can see it climbed to 99.8%, crashes down to 3.3%, then it shoots back up to 93.8%, and then they lose the game. They lose the game outright. So when you look at this as a model, what's actually happening here? Well, these don't actually represent probabilities. They're implied probabilities derived from the market equilibrium price. We're literally backing out probabilities from whatever the market is trading that event at. Economics tells us through supply and demand, we have an equilibrium price. So it should represent the best probability of that event occurring, right? Well, no, because economics also assumes that agents act rationally, but they don't. There's plenty of literature suggesting, especially in finance, that structurally the market is mispriced. In fact, nobody would trade if it wasn't. So when we're dealing with an uncertain system and we're looking at probabilities, we're not actually looking at probabilities in the random system sense, where we actually have convergence. In other words, if I was to simulate this fourth quarter 10,000 times, I can't actually do that, but if I was to simulate that exact same setup 10,000 times, I wouldn't get the implied probability that I started the fourth quarter with. Look, when we marched into the fourth quarter, the first time around, it was 99.8% implied probability, and the Broncos had what? A 0.2% probability of winning. That is where the market was effectively pricing the outcome of the game at. But if we were able to simulate this fourth quarter 10,000 times, what does it actually converge to? This is just an example. We can't actually replay that fourth quarter, but look, it converges to 70-30. We grossly overestimate the probability of the Giants winning. So how does this impact our model, and how does this impact the decisions that we make? Well, we always need some way to assess the likelihood of different events occurring, and we tend to model uncertainty with random variables and other types of models to accomplish this, but they aren't actually random variables, and we can end up making assumptions, building models around things that are just fundamentally not true, creating these mispricings. And the market itself in equilibrium can also do this. We're going to take a look later on at the 2008 financial crisis as another example of this. So in other words, when we're looking at something like this, there is no convergence. When I have a 99.8% probability marching into the fourth quarter of the Giants winning, what happens? We simulate this fourth quarter 10,000 times. It doesn't converge, unlike the random system we saw here. Now, what does this leave room for? This leaves room for making optimal decisions in the face of uncertainty. Nobody knows the Giants like me, and my edge is knowing for sure that they were going to somehow lose that game. So if I chose to take the opposite side of this contract, I would have received an absolutely massive payout. If I do that on average, and I'm correct on average, I can accumulate a significant amount of wealth. So this is exactly where models come into play, and understanding their limitations, understanding how to make informed decisions based on them. In any case, this is leading us into the discussion of why quant models break. We now understand the difference between a random system and an uncertain system. We saw an example of each. How can we now apply this to stock returns? And how can we understand what happens in the case of these black swan events? Let's look at a real world example to understand why quant models break. If we can understand why a simple model breaks, we can extend that idea to even the most complicated of models. So let's just start by taking a look at this return distribution. This is historic returns for NVIDIA. I'm going to look at the 50th percentile, and I'm going to look at the average return above and the average return below. And what you'll find is, wow, I have almost double the average return above the 50th percentile and almost half the negative return below it. So that's positive EV. If I invest in NVIDIA, that's a positive EV decision. There's edge. Let's bet the house. Well, hold on. This isn't quite how modeling works. What's going to happen if I just base my entire decision to invest in NVIDIA on these historic returns? Well, let's suppose that it's just about to be 2026 and I'm going to make a massive investment in NVIDIA. I looked at that distribution profile. It looks like there's edge, and I simulate a whole bunch of sample paths. Based on this, I'm doing great. And then, whoa, what happens? I'm starting to lose all this money. Why am I losing all this money? I just ran a very simple model and it told me what? Over half the time, I'm making on average double the return than the lower percentile. But if I run this simulation, you can see I start to accumulate wealth into 2026, and then there's this massive drawdown. What happened? Well, effectively, our quant model broke. It doesn't matter how complicated your model is going to break. So, why do quant models break? Well, we're dealing with an uncertain system. Nothing is fixed, no probabilities are fixed, no statistics are fixed, and there is no convergence. Our model is not capturing the dynamics that we're actually going to realize in the market. If you take a look at this simple model, this is completely fixed. The data generating distribution for NVIDIA returns doesn't actually look like this. If we scroll up to our random variables here, these are all fixed. Yeah, they literally represent a coin flip, the number of heads out of 10 coin flips, and the sample average. Yeah, those are fixed distributions. They literally represent the outcomes, but the data that we observe empirically, that doesn't represent the data generating distribution. If I was to simulate the data generating distribution here, you're going to see it changes over time. It changes its location, its mean, and its variance. And we're going to realize empirical stock returns based on wherever that unobservable data generating distribution lies. Moreover, there are latent processes that drive this distribution in a particular direction. If volatility is higher or lower, it can shift the spread and the center of this distribution. And we can see this realize in our sample path. This is our stock price path effectively. This is what we saw happen here when we applied our model, and what happened? It broke. This is why we're not effectively capturing these dynamics, and even if we did, then something else is going to cause the model to break entirely. Some other catalyst, some other exogenous factor, which is why this is a full-time job. You don't just build one model. You continue to build many models to try to capture all of these different effects, to try to make the best decisions that you can in the face of uncertainty. If we want to get even more specific, what I want you to notice is this is the unobservable data generating distribution. This is effectively what we're trying to model when we're looking at the empirical data here. But we notice this changes over time, right? It shifts and it changes the variance, the spread, and the likelihood of observing these extreme returns at any one point in time is going to change. So when I looked naively up here at this simple model, I said, oh, 50% of the time I'm realizing double the return on average. 50% of the other time it's half that return in the other direction as a loss. And that's some edge. That's great. Well, that's not how it works, right? If we're looking at it in this way where we actually simulate a time variant distribution, we can see that the likelihood of negative returns and the likelihood of positive returns changes over time. So when we look at this simulation above now, right, and we see our naive model break down, we understand why. Once we start realizing a whole bunch of negative returns, we realize that, hey, the unobservable data generating distribution is generating returns now with a higher likelihood to be negative. And that is what we experience here. And it's exactly what causes our quant model to break down. So this is how we have to interpret the space. There are a lot of factors that go into this unobservable data generating distribution to understand how to build effective models and essentially create extensions that are better, more complicated to capture these dynamics and come up with better likelihoods that enable us to make better decisions. We need to understand market dynamics, macroeconomics, politics, and how to actually build these models. We need to understand the math, probability and statistics, finance. This is why I always say to master your quantitative skills, you need to make your own informed decisions in the face of uncertainty. Nobody is going to play that hand of poker for you. Effectively, I'm telling you to be skeptical of both the market and your models. Let's talk about black swan events like the 2008 financial crisis. We had one of the strongest housing markets in history, and you better believe some of the smartest people in the entire world were working at those banks and other financial institutions that ended up going bankrupt or getting bought out. So what happened? Why were there no adults in the room? Well, effectively, you have to look at the entire space as uncertain. Nobody knows what the outcome of any one event or the next event or a series of events is going to be. Nobody, no model in the world, no insider information. Even if you know you're going to have an earnings beat, it does not necessarily mean the stock price is going to go up. This is why our quant models break. Everything changes over time. This is a very simple example to illustrate the idea of a quant model breaking in the context of the financial crisis. On the left here, I have a risk model path. This is going to tell us how many standard deviations away from our mean expectancy, our tolerated risk level, we are. And on the right here, this is going to be the value of insurance on the mortgage market. We know that everything ended up defaulting, right? All of those CDSs paid out massive. Everyone's seen The Big Short here, right? So when we look at this chart, if I run this animation for you here, you're going to see, okay, we're within a reasonable risk threshold. And then bam, we have a almost 20 standard deviation jump away from our tolerated expectancy. And then the insurance pays out massively for holders of those credit default swaps. So what happened? Don't all of these banks and hedge funds have quants at them? Well, they do. And they did build models, and some of them were even able to liquidate on the way down, or maybe they were even able to get out of it beforehand. But in any case, what I'm trying to suggest here is this was driven by an exogenous factor. The folks in that movie who were able to capitalize on this insurance modeled it with an exogenous factor. If you're unfamiliar with this idea, this is getting into the idea of developing models with even alternative data. And I have a video on time series analysis where I talk about this in more depth. If you're unfamiliar, I highly recommend you check that video out. But that is exactly the purpose here is quant models break down. If you're missing factors, you can't account for them. So when you look at something specifically like this financial crisis and you look around and you say, hey, where were all the quants to make sure this didn't happen? Quant models break, and that's exactly why. So why do we bother? If our models are making assumptions that are wrong, what's the point? One of my favorite comments that I get on all of my videos are, hey Roman, that model is wrong. No kidding, the model is wrong. If we knew the dynamics of the data generating distribution or process, we wouldn't need a model in the first place. But a more reasonable question to ask is, what's the point? Why do we bother if we know these models are incorrect? And that brings us to the purpose of modeling. Let me propose to you this idea. Let's say you are serving a business function. You're making a market, you're some sort of trader, whatever. You have to act. You don't get to just sit there and say, hey, I don't know what to do. I don't know if it's going up or down or left or right. I don't know what to do. I'm just going to sit there and I'm not going to act. No, your job is to serve a business function. You have to act. Okay, now that you have to make a decision, how do you want to inform your decision? All right, are you going to do media blackout? You're not going to read the news. You're not going to have any sort of quantitative guidance? No, you're going to want some model next to you to be able to help inform your decision making. This is exactly our goal. Our goal is to develop models and keep redeveloping and optimizing models so we can make informed decisions in the face of uncertainty and act with an edge. Our goal is to accumulate expected value over a series of actions. This is what it means to optimize your policy function, to act with positive expected value. Our goal in any system where we're dealing with uncertainty is to accumulate expected value or our edge over time, over a series of trades, investments, bets, whatever it is. If we're acting with positive expected value, then we are going to continue to make progress. Otherwise, we are not going to, and we are going to end up losing money or not making any progress. Our goal is not to predict the outcome of any one event. We don't build a model to predict the price of a stock tomorrow, take out a massive loan, and bet everything on black. That's not our objective. Our objective is to accumulate edge over time, making small independent decisions with positive expected value to accumulate edge. That is the goal. But this goal isn't just going to apply to trading and investing. I'll get philosophical on you here too. This applies to everything you do. This applies to your goals, health, investing, so on and so forth. Interviewing, applying for jobs, everything. You can have an edge. We've all heard of this idea, having an edge against the competition. That's precisely what it means. That's specifically in a zero-sum game, but it doesn't have to be. How can you have an edge in your health? Having knowledge of optimal workout and diet. How do you have edge in achieving your goals? Discipline, that's an edge. Investing, edge in experience, understanding different regimes, that your models are imperfect and will break down, that drawdowns aren't forever if you're investing in a market portfolio, removing this idea of emotion, so on and so forth. The purpose of modeling is to make informed decisions in the face of uncertainty, not to predict a specific outcome. If we can continue to, on average, make informed decisions in the face of uncertainty, we accumulate edge, and that is our goal. Too long didn't watch. Here's your executive summary. There's a substantial difference between a random and an uncertain system. In either case, we can never predict the outcome of any one event. This is where the major source of confusion comes in. This is why people think that trading is just gambling. It's not. The stock market is uncertain. It is not random. Economics suggests equilibrium prices are fair, but this is only true if agents are rational, and they are not. Equilibrium price is far from perfect. Moreover, implied probabilities are some of the most perfect examples of irrationality and mispricing. There is no convergence, misrepresenting the idea of probabilities from a random system that we saw in the weighted coin flip example. In this vein, quant models break. Uncertain events can't be replayed under the same conditions as random events. There is a lot that goes into the outcome of an uncertain event. We can't possibly model every factor. Quant models will break. Dynamics and reality are far more complicated. We have to continue to build better models constantly and continue to adjust our assumptions. That is our job as a quant. All models are wrong, but when we are met with uncertainty, we have to take action. We can't just sit there and choose not to act because we don't know. We don't get to not act. We have to make a choice. Models aid in making informed decisions by tying likelihoods to certain outcomes. This allows us to make optimal decisions with these structures. It's both a skill and an art. And if we're making optimal decisions in the face of uncertainty, on average, we will accumulate edge over time in any system. This could be in any sort of goal you're trying to achieve, your health, studies, wealth, whatever it is. Your goal is to act optimally in that uncertainty and accumulate edge. Some future topics, technical videos, and other discussions to look forward to. Looks like a lot of you guys want to see this video on advanced Markov chains, so I'll look to start putting that together soon. I'd like to get back into stochastic processes, Brownian motion, arithmetic, geometric Brownian motion. I'd like to talk more about fractional Brownian motion, this Volterra process. One of my all-time favorite topics to study is these non-Markovian structures. Let me know in the comments if that's something you'd like to see. You will make my day. Deriving the Black-Scholes equation, the PDE, analytical numerical solutions, really getting back into this math. I know we have to tackle this Kalman filter and non-stationarity. This is a big problem in quant modeling, just as we saw herein. I want to talk about the most popular quant models for informed decision-making, informed trading. This gets into the idea that we discussed at the end of this video, accumulating edge through optimal decision-making under uncertainty. And maybe even some more qualitative videos like buy-side versus sell-side quants, maybe even my experience as a quant. Let me know what you'd like to see in the comments below. And don't worry, I haven't forgotten about our quant builds. We've already built that earnings event trading dashboard. I had a blast making that video. Maybe we can do one on a live Kalman filter implementation with regime dynamics. We've already covered Markov chains and hidden Markov models. I'd love to build something like that. And of course, this automated delta neutral trading system, which I have continued to flesh out. I'm almost done with the base script. I think that would be a great video to do together as well. But Let me know in the comments what you'd like to see in the coming videos. That's going to do it for this video on why quant models break. I hope you enjoyed. I hope you learned something. This video certainly took a lot of effort to create, so if you enjoyed it and you want to see more like it, please like, comment, subscribe, share. Again, it helps me out tremendously. It is always greatly appreciated. If you'd like to master your quantitative skills, check out quantguild.com. If you want to chat with me one-on-one, link to my calendar in the description below. Other than that, thank you so much for watching, and I will see you in the next video.